Take a look at Cramer's COVID-19 index. Meanwhile, it's a list of 100 stocks that span more than a dozen sectors, and the companies expected to produce a return during and beyond the pandemic. Some winners on the list are growth stocks that people have come to love over the past year. Names like Zoom and Peloton and DocuSign. But then there's been the rotation into value stocks, or the so-called reopening trade. Now, this trade's already worked pretty well, but are we already seeing signs that it's fizzling? Here to break it down, Stephanie Link, Chief Investment Strategist at Hightower and a CNBC contributor. We had this. This is part two, or at least it's episodic, Stephanie. We talked about this last time you were on because a while ago you were advocating some of these names. You've got some reasons why we may be seeing what could be just normal consolidation. Doesn't mean the trade is over, or it could mean that maybe it is long in the tooth. What could be causing the not weakness, but they're not doing as well as they were? What's causing it?
Yeah, good morning. I think it is a little bit of a few things here. It's the Delta variant and the unknowns there. It's also the flatter yield curve, which favors growth over value. And why are we seeing a flatter yield curve? It's because people think we've seen peak growth and peak inflation. I'm not in that camp, as you know, but that's what I think is happening. Plus, the reopened value cyclical trades really outperformed from January to May. Value outperformed growth by 12%. That spread in May into June has narrowed to 3%. So growth has really made a comeback. I think earnings are going to be terrific, especially on the cyclical sectors, financials, materials, industrials, energy. And I think that's why I'm staying involved on the cyclical side. You don't want to abandon technology, secular growth. We get the reasons. Total addressable markets are enormous. So you want to have kind of a blend of both. I do lean, though, more cyclical, especially since we've seen the pullback.
70-30. That means you like cyclical's value over secular growth. 70-30, I quickly deduce that you're more that you have twice as much in the former than the latter, right? Even more than that, right? So this is a real thing that.
Yeah,
I
do.
Yeah, which ones? Which ones?
Look, I would say this, Joe, you know, that I am overweight big time in financials and industrials and even in energy. But energy is only 3% of my benchmark, so it's not really that big of a bet, if you will. But I do believe the financials, the CCAR news that we got yesterday and last week, really good news. You're going to have dividend yields in the 3% range on many of the financials. You're going to have huge buybacks. You've got huge support every month coming in from these companies, and I don't think you want to ignore that. Plus, not only that, these stocks are down about 4 to 10% in the last, let's say, month and a half. So you're getting these things at 1.1 to 1.5 times book. Industrials, again, just I mentioned, if you think the economy has legs to it in terms of the strength, in terms of inflation, then you want to have industrials, and especially since they have pricing power. So those weren't the names I actually gave you this morning, but those are the reasons why I am overweight, and those are the bigger bets that I'm making at this point.
You like McDonald's. I know. She said I'm overweight. I know. Whenever you say that, I think
the afternoon show talks so differently or speaks so differently than we do, Stephanie. We never say that, and you are,
overweight. Yeah, but whenever you say it, I think
know I'm overweight.
I don't know, for some reason I take it. I don't know. I internalize that, and then I see McDonald's as your pick. And I will admit, I immediately am thinking about a sausage and egg McMuffin. I immediately thought about that because we get those sometimes here. Max.
Oh, you guys are so funny. I literally just got the treadmill, so I can recommend McDonald's, right? So.
So good. And then we can get back to our sausage discussion. Why menu simplification? Strong free cash flow. McDonald's is one of your favorites, right?
It is, and it's a new position for me, quite frankly. I actually sold Marriott for it. Yeah, because look, I'm up 64% in Marriott, right? And I think it's going to be terrific. And I have plenty of reopen in that area. I mean, I have a huge position in Wynn and Las Vegas Sands and that sort of thing. So I'm there in terms of reopen. But McDonald's has actually lagged. It's only up about 7.7%. And yeah, the fundamentals are actually pretty good. They have simplified the menu. They've got drive-thrus in 95% of their U.S. stores. That's a huge win, a huge benefit for them. Digital enhancements, and then drive-thrus are now 75% in the system. So they have done a really good job. And I think basically it is a reopened name. People will go back to the restaurants and go inside the stores. But in the meantime, they're handling things just well. And as I say, it's lagged. It's only up 7.8%. So I think it acts like a staple. And I like to have that, actually.
Shepard Smith here. Thanks for watching CNBC on YouTube.